Ladies and gentlemen, good day and welcome to Welspun Living Q1 FY27 earnings conference call hosted by 360 ONE Capital Market. As a reminder, all participant lines will be in the listen only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Aradhana Jain from 360 ONE Capital Market. Thank you and over to you, ma'am.
Thank you, Yusuf. Good evening, everyone. On behalf of 360 ONE Capital, I welcome all participants and the management of Welspun Living to the 1Q FY27 conference call. Without much ado, I hand over the call to Ms. Bharti Agarwal, Head Investor Relations, Welspun Living, to introduce the management. Over to you, Bharti.
Thank you, Aradhana, and good evening, everyone. On behalf of Welspun Living Limited, I would like to welcome you all to the first quarter FY 2027 earnings call. On this forum today, we have Ms. Dipali Goenka, Managing Director and CEO, Mr. Manish Bansal, Chief Financial Officer, and also Mr. Harsh Rungta, Group Head Investor Relations, Welspun World. Apologies for the delay in filing the results due to some technical glitches. We hope you've had the opportunity to review the earnings presentation, which has been filed with the exchanges today and is also available on our website. During the course of today's discussion, we may make references from this presentation. As usual, we'll begin with the opening remarks from the management, following which we will open the floor for a Q&A session. Should you have any additional questions after the call, please feel free to reach out to us. With that, I would now like to hand over the call to Ms. Dipali Goenka. Over to you, ma'am.
Thank you, Bharti. Good evening, everyone, and thank you for joining us for Welspun Living's Q1 FY27 earnings call. We have started FY27 on a strong note, delivering broad-based growth across our businesses, continued margin expansion, and further strengthening of our balance sheet. We had the strongest quarter in 7 quarters, with our consolidated revenues growing 23.5% year-on-year and 15.4% sequentially to 2,828 crores, while EBITDA margins expanded to 12.5%, improving by 140 basis points year-on-year and 170 basis points sequentially, driven by healthy volume recovery, operating leverage, and an improving business mix. Profit after tax nearly doubled, with PAT margins improving from 3.8% to 5.7%. More importantly, Q1 revenue is 9% above the same quarter of FY25, the pre-tariff baseline. We are not simply returning to where we were, we are ahead of it. Margin expansion is now in its third consecutive quarter from 6.8% at the trough to 12.5% today, and it is structural, not circumstantial. Across our manufacturing network, we have been systematically simplifying processes, accelerating automation, and deploying AI tools and Industry 4.0 technologies on our shop floors to drive sustainable efficiencies. These are capabilities that compound. The organization we are building is genuinely different from the one that entered the tariff disruption. The macro environment is more constructive than it was a year ago. The recently announced US tariff framework has currently preserved India's competitive position. The India's US BTA talks are progressing, and we remain optimistic of a positive outcome. India's moment in the UK market has arrived and presents a significant growth opportunity for Indian manufacturers. The India-UK Free Trade Agreement, effective 15th July, puts India on an equal tariff footing with Pakistan, which today holds over 50% of UK home textile imports. We are not starting from scratch here. Christie, our Disney brand relationships, and our established retailer network mean we are already embedded in this market and ready to scale. Our UK and Europe businesses delivered 20% plus growth this quarter. The runway ahead is significant and we expect double-digit growth in our UK businesses over the coming years. Home textiles exports grew 28.1% year-on-year, our strongest quarter in recent years. Behind that number sits a business that is difficult to replicate. We continue to be the world's largest exporter of terry towels. That position is not just maintained by scale alone. It is built on technology, innovation, and customer trust accumulated over 3 decades. Our IP portfolio stands at 50 patents. That is a moat, and it is deepening. Innovation-led sales grew 16% this quarter and contributed approximately 25% of our revenue. Our US onshore pillow businesses grew 2.3x this quarter. The Ohio pillow facility has ramped up to around 81% utilization. Our Nevada facility has commenced operations and is building momentum in sleep category. Together, these facilities strengthen our customer proximity, improve speed to market, and enhance supply chain agility. We are on track to double revenue to reach $60 million this year. On our branded businesses, Christie delivered 16% growth this quarter, supported by strong UK performance and expanding presence in the Middle East and growing traction in the United States. Wellhome is increasing acceptance across North America, Japan, and newer markets. The recently concluded Wimbledon Championships was watched by millions of fans around the world. Every towel on the center court was a Christie towel, continuing a proud partnership spanning nearly 4 decades. The Christie monogram, woven into our signature hydrocotton towels, featured in courtside moments, player interviews, and iconic images throughout the tournament, bringing together 175 years of British textile heritage and modern manufacturing excellence. In India, our domestic businesses grew 21.3% year-on-year, sustaining the trajectory from Q4 with Welspun and Spaces continuing to strengthen their presence across key channels. Our B2B and B2C both grew in strong double digits. The ongoing shift from the unorganized to the organized home textiles market continues to be a structural tailwind for our businesses. Our widely distributed brand position as well to capture an increasing share of this opportunity. In flooring, our turnaround efforts are also beginning to deliver visible results. EBITDA margins materially improved to 10.4%, highest in over 2 years, reflecting operational discipline and structural actions taken over the past year. Alongside improving profitability, we are diversifying beyond the US into markets such as Australia and Canada through strategic partnerships and strengthening our presence in commercial flooring. Our continued commitment to exports, innovation, and sustainability was also recognized during the quarter at the Texfocil Export Awards 2026, where Welspun Living received the Platinum Trophy for the highest global exports and Gold trophies for innovation and excellence in ESG. These recognitions reinforce the differentiated position we have built in the global marketplace. Before I close, I would like to briefly address the unprecedented flooding at our Vapi facility. Post the incident, our immediate priority was the safety of our people, and within a few hours, every person on site was evacuated safely. Operations partially resumed within a week and are expected to be restored in a phased manner. Our teams responded swiftly by activating contingency plans and rerouting production. We are fully insured and are working closely with our insurance providers to facilitate the claims process. What stays with me from this episode is not just the disruption, but the response, the agility, and ownership demonstrated by our teams reinforcing the resilience of organization. That is the Welspun spirit. To conclude, we remain focused on building on this resilience and translating it into sustainable growth and profitability. We remain confident of delivering double-digit revenue growth and EBITDA margins in the low teens for FY27 and remain well-positioned to capitalize on the opportunities ahead. With that, I will hand over to Manish to take you through the financial performance. Over to you.
Thank you, Dipali, and good evening, everyone. I will keep my remark brief. We have started FY27 with a strong financial performance, reflecting broad-based growth across our business and continued improvement in profitability. Consolidated revenue grew 23.5% year-on-year and 15.4% sequentially to approximately 2,828 crore, while EBITDA margin improved to 12.5%, expanding by 140 basis points year-on-year and 170 basis points sequentially. This marks our third consecutive quarter of margin improvement. The improvement in profitability was driven by a combination of healthy volume recovery, operating leverage, better business mix, and sustained cost optimization initiative across the organization. At the same time, our ongoing focus on manufacturing productivity, procurement efficiencies, automation, and process improvements continue to strengthen our underlying cost structure. These structural initiatives are expected to support sustainable margin improvement as volume continue to recover. Alongside improving profitability, we have continued to strengthen the quality of our balance sheet through disciplined working capital management, healthy cash generation, and prudent capital allocation. Our capital allocation philosophy remains unchanged. We continue to invest selectively behind projects that enhance productivity, improve operational efficiency, and strengthen our long-term competitiveness. As part of this approach, the board approved a 121 crore rupees debottlenecking and modernization project at our Anjar facility in July, which will replace older technology with more advanced technology, improve plant utilization, and enable us to drive several evolving markets demands. This forms a part of our overall FY27 capital expenditure. Overall, we continue to expect FY27 capital expenditure in the range of 400 to 500 crores. In parallel, we have also made significant progress in transitioning the Anjar manufacturing complex towards a greener power ecosystem. With this commissioning of the CTU line, the facility commenced receiving 100% green power supply from mid-July 2026. This marks an important step in advancing our sustainability commitments. With Anjar now fully powered by green energy, 79% of Welspun Living total power consumption is now green. On the tariff refunds, the process is progressing in line with the applicable regulatory framework. We have initiated the necessary procedures for eligible claims and wherever applicable have started receiving refunds. The timings and quantums remain subject to completion of the administrative process. Looking ahead, our priorities remain unchanged. We remain focused on improving not just growth but the quality of growth by strengthening cash generation, enhancing asset productivity, maintaining disciplined capital allocation, and delivering sustainable improvement in return ratios. We continue to target an improvement in ROCE to the low teens during FY27 and believe our strengthened financial position provide a solid foundation to support the company's next phase of profitable growth. With that, we would now be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Samantha from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. So, ma'am, just wanted to check a couple of points. Why did gross margin declined in this quarter? Any particular reason? I mean, I know that raw material has been an inflationary trend. Anything you want to highlight on this particular point?
It's primarily because of the raw materials. And if you look at it, even going forward, the raw materials will be something that we'll have to watch out for. And of course, the macroeconomics factors are also playing, whether it's your crude that you're seeing and cotton. So these are the two important ones that we can really talk about here.
So for next couple of quarters, will it be in the same range, assuming that raw material is in the similar level as of now?
Yes. Yes. We will maintain, the numbers that we are projecting today as well.
Got it. Second thing, within home textile, if I just look our volume numbers in home textile, bed and bath. Bath, I have seen the 2% volume growth, and bed volume was down. So just wanted to check, most of the growth came from a realization, right, for this quarter, is home textile?
No. It is a mix of volume and value. And there are a lot of times there's a lot of GIT factor also that comes into play. So it is everything that is realized in this quarter. And you must appreciate, in the textiles, as we dispatch, it takes 50 to 60 days, So definitely there is that kind of a stagger effect in this.
Okay. And one follow-up in that one of our competitors have pointed out that some issue on this container availability and all. So for us, there is no any kind of issues we have faced in this quarter, right?
So let me just tell you a few things here. We have long-term partnerships with all the freight carriers, and that has yielded results. And whatever we will continue to do, it'll be in the terms of a path that we are very comfortable with. And the market rates have increased, but our impacts to the customer dispatches will not be impacted here.
Okay. And last question from my side, when we are saying that double-digit revenue growth, so we are indicating a mid-teens or mid to high teens? How we are indicating the numbers for next couple of years?
You've seen the growth this time, and we will maintain.
Okay. Thank you very much. Thank you.
Thank you.
Thank you. Next question is from the line of Prerna Jhunjhunwala from Elara Securities. Please go ahead.
Hi, thank you for the opportunity. Just wanted to understand the bed linen utilization rates. Are we seeing further traction with UK FTA, and can we assume that it will be about 80% for the year as a whole, or any color on the utilization rates for bed linen that we can expect for this full year?
Prerna, our utilizations will be over 80% across, and that's what you will see, you'll continue to see. And it'll be, with our mix that we have, and that, with the US, UK, Europe, rest of the world, we have a very healthy mix of retailers. So that goes without saying that, we will continue to grow, expand across all the geographies, and our utilizations, in fact, across all our verticals will be around 80%.
Okay, understood. And what kind of traction are we having with UK and Europe, European clients? Have they started giving orders given the UK FTA has been signed? And yeah.
Sorry, Prerna, you can continue if you have to.
No, I just wanted to check on this, that whether European clients are also looking forward to diversify their sourcing, because it is largely sourcing from one particular country. So,
yeah,
how are we seeing that these two geographies playing out?
We are actually, I think I can talk about India also here, Prerna. And as the FTAs have opened up for UK, then Europe is right around the corner, and the other countries also just coming through. We are in a very good position as a country. And for Welspun as well, as you already know, that UK, we actually had a 20% growth. So we already are in this market, but we can also see a big upside. As you already know, that Pakistan actually controls around 50% of the share in UK. When you talk about Europe as well, they are the retailers we already are working with, and we see a great upside there as well. To your question, yes, UK and Europe are going to have an upside for us with the FTA as well.
Have the order inflow started, ma'am? Just wanted to understand from that perspective for at least U.K., because Europe is still around the corner, but U.K. is already implemented.
Yes. Yes, Prerna. This already started with the conversations that had begun when the FTA conversations had begun. So the inflow, see, it is a process, Prerna. As we approve, the product, then it is kind of a product development. So it's a cycle. So the discussions have begun, approvals are happening, confirmations are there. So this will gradually come into our system.
Okay. Okay. Understood. The second question is on the flooring part. One of the best margins that you have reported in this quarter at around 10%, 10.4%. Just wanted to understand the levers that help to improve the margins, and are these sustainable?
So in the flooring, the important thing actually is a strategic shift towards soft flooring, where our categories, which are in the terms of area rugs and the others, we have actually focused on qualitative products. So the margins hence definitely have seen an upside. Along with that, focusing on different partnerships like with Australia, New Zealand, and Canada. So there is a target, there's a certain target of products, there's a certain target of margins, and also we are looking at our costs as well. So overarchingly, it has held us in good stead, and it will continue to do so.
So we can safely assume 10% margin for the entire year and going forward. Is it doable?
Yes.
Okay.
Mostly. Yes. Yeah.
Oh, thanks. I'll come back to the question queue for any further questions. Thank you, ma'am, and all the best.
Thank you, Prerna.
Thank you. Next question is from the line of Roshan Nair from Antique Stock Broking. Please proceed.
Thanks for the opportunity and congratulations on good set of numbers. So your margins have expanded to around 11.5%. So can you help me understand whether this is a bigger structural change that is happening on the demand side, or is it because of the company's internal efficiencies? And what is the scope for further improvement, and in which areas?
So I think there are three clean drivers that you are seeing. The volume recovery and tariff share unwinding converting into operational leverage on the largely fixed cost base. The business mix is improving. That is the second one. Third is the cost discipline. The structural cost actions that are taken over last year, reducing energy cost, automation improving, and the throughput, I think have held us in a good stead. So, as we have already spoken, that a full year guidance for EBITDA margins will be targeting around low teens, and that's what it is going to be.
Understood. That's helpful. And also, can you quantify the impact that can come up in this quarter due to the floods? Maybe some idea over there?
So, with Vapi, if I can say that we are covered with the insurance adequately, and quarter two will be impacted because it has been an onslaught right now and it has been very tough. But however, I can tell you that the quarter three, quarter four, we are going to restore. So annually, if I look at my growth as Welspun Living, it will continue to give the double-digit growth, and we'll be on the track.
Understood. That's helpful. Thank you so much, and wish you all the best for the coming quarters.
Thank you so much.
Thank you. Next question is from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Congratulations to the entire team for a very strong numbers and a positive outlook also. Ma'am, couple of questions. First, I missed out on the capacity utilization across segment, what you are targeting for the entire fiscal. Because the bed linen, I believe, was 60% in quarter one. So what's the outlook going forward?
Our utilization annually is going to be 80% across all the categories. Let me just be very, very clear on that, whether it's our towels, whether it's sheets or rugs. This is just a staggered kind of a lag that you can see where you are seeing these utilizations. But as we go forward, it is definitely going to be 80% across everything.
Oh, that's a very strong numbers if the bed linen crosses 90% utilization. Again, my second question is on
I said
advanced.
80%. I said 80% across all the categories.
Yeah, but for the
Yeah.
full year, 80%, which
Yeah.
means the coming quarters, the bed linen should be crossing 90%, right?
Yeah, it will depend on quarter two, quarter three, quarter four, but the average we are
Sure.
talking about an 80-85%, yes.
Sure. My second question is on advanced textile and domestic retail business, how they are doing, and is domestic retail now EBITDA positive?
So domestic retail this time actually has worked pretty well, and we are actually seeing a double-digit growth, around 20%, and we are around near about break even. And this will be something, where, as we grow this business, we are on the target to achieve 1,000 crores. And, we see both our businesses, Welspun and Spaces, both have continued to show a great growth across the country.
Sure. Third
And,
question. Yeah.
Yeah, go ahead.
On the flooring business, we saw first time double-digit margins of 10%. So are that margins sustainable, or was there a one-off in that margin?
No, this is going to be sustainable, as I spoke earlier as well, that there is a lot of work that is done in the qualitative business that we are taking, in the terms of soft flooring. There's also in the geographic diversification that we're working on in the terms of different countries like Australia and New Zealand. And lot of cost controls have been also taken on here. And, and hence you are seeing this number, and which you will continue to maintain. We are very, very comfortable with it now at the moment.
Great. Thank you and best of luck. Yeah.
Thank you.
Thank you. Before we move to the next question, a reminder to the participants: to ask a question, you may press star and one. Next question is from the line of Deepali Kumari from Aryan Capital Markets Limited. Please go ahead.
Thank you for the opportunity. I have a couple of questions. Like your EBITDA margin stood at 12.5%. Given your normalized target of 15%, so what are the key levers required to bridge this 250 bps gap? Is it purely operating leverage or further mix optimization? And does this guidance factor in potential site cost spikes due to ongoing West Asia conflict?
So, I earlier spoke about it, Dipali. I spoke about, it is going to be a mix of the volume recovery that we've had, the tariff share unwinding, that is converting into the operating leverage on a largely fixed cost base. So, fundamentally, business is also improving. The mix is also improving. The quality of business is getting better. And of course, it's also about the cost discipline. And when you talk about the numbers to a question of, 15%, it is going to be a gradual process towards 15%, which we have spoken about. So right now it's 12.5, and as we grow forward in the next 1 year, we will see that moving towards 15%.
Okay. And like with the medium-term aspiration to move your non-US revenue mix from 41% to 50%, so what specific geographic region you are expected the contributor for this set?
See, let me just give you a perspective, and I think I've earlier also told you that United States is still the biggest that is there. UK is, the UK home market is around $5 to $7 billion, where Pakistan is around 50%, and this is the market share we will definitely take. This stands for us to gain, and we will continue to grow this. We already are in conversation with a lot of retailers here. Europe, again, as is also right around the corner. Our conversations with the retailers have already begun, and we already are working. We are in the working relationship with these retailers as well. So as we continue to grow, America will be around 50-51%, mostly, or 55% in the rest of the world, which will be UK, Europe, Japan, and the others will contribute to this portion, including India as well.
Okay. And one more thing, like global B2B business, others this quarter grew more than your global branded business. So are we prioritizing private label partnership over our own branded portfolio in the current environment?
It's always been our, B2B business. And if you look at it, if you have seen it, our branded business is around 18%, but our B2B business will be the strong one, which is actually the anchor of all the businesses. You know, and that is what is going to continue to grow far more, strongly. Our brands will also, like we already are looking at $100 million in the terms of our global brands as well. So that is also holding on very, very strong with us. So I mean that is also seen a year-on-year growth of 27%. So I somehow say that we've done pretty well here, actually.
Okay. And on the tariff side, like currently, who is absorbing the cost? Like, if you can give the split between Welspun and the retailer and the end consumer.
So, this is Manish here. Thanks for this question. So it is always been a mix of things. So it has never been straightforward. Sometimes it is customer, sometimes consumer, sometimes we are bearing. So it is always based on case to case, customers to customer, and program to program. So, but that is already baked in all this cost into this margins, what we are seeing. So now it is part of our life. We were at 50%, we are come out from that. So now we can see it much better anyway, going further.
So, so as you said, as Manish said, it's going to be a mix of all the three because anyway we partnered with our retailers and the retailers passed on the price increase to the consumer, and that's the way it was. And now we are behind that. That's all behind us, and it's now 10%, and we are pretty good there.
Okay. And also, you wanted to be a leadership on the sleep ecosystem. So, does this involve a product category expansion beyond seats and pillow, like smart bedding and mattresses?
Mattresses is not something that we are talking about. We speak about pillows here, and we will continue. And as I spoke, and I said that we are on track, and we are on track to achieve around $60 million in this year in a pillow. As you know, Nevada has also commenced operations. Ohio is already at 80% utilization.
Yeah, thank you so much. All the best.
Thank you.
Thank you. Next question is from the line of Ronak Shah from Equirus Securities. Please go ahead.
Thanks for the opportunity and congratulations on a good set of numbers. My first question is on the US retail front. So, how the management is seeing the traction over there, how the overall demand shaping up in terms of order book and near to mid-term visibility you are gauging, though you are highlighting a double-digit top-line growth, but just from the retailer demand and the secondary kind of thing.
So I can tell you that consumer spending across the all the segments is really very, very healthy. The retail sales actually grew 5.2% year on year in May, and also if you look at the recent consumer data, it looks pretty healthy. I mean, if I can say across Father's Day, Mother's Day, and the other occasions like back to college season were very, very healthy. The footfalls have increased across the key retailers. So hence, like if you look at it, the demands, America all said and done, and Fed has actually held on their Fed rates as well. So overall, America is really very resilient in the terms of what they are doing, and the growth is looking very, very healthy. The momentum is there of consumption as well.
Understood. Second, on the freight front, tariff front. So when we are seeing a 10% overall tariff right now, and things are uncertain, but by what level of tariff the company is quite confident to see a balanced sort of performance? Because one of the player into the textile space has highlighted that up to 18 to 20%, they are quite confident to manage the overall performance and the margin.
See, it is a matter of what the other countries get in the terms of their tariff rates, and somewhere we have learned that it is always a partnership and a collaboration with our retail partners. So wherever the tariff was even 25% to 50% and to where we are, and as we go forward with the BTA that kicks in, we will work with our customers, and we will take it from there. So it is always going to be not a one-sided approach. It is always a collaborative approach. And already the tariff impact has already been passed on to the consumers, which hasn't been retracted in the United States of America.
Understood. On the margin front, ma'am, can you highlight that on a FY27 whole base when we are expecting a mid-teen side of the margin, though in near term, considering the current RM inflation plus certain OpEx headwinds, how the near-term margin, specifically from the second quarter perspective, will look like?
We will continue to maintain these numbers, and we'll work through them, and we will maintain our numbers that we have committed on the low teens.
Fair point. And lastly, ma'am, on the overall profitability. So when we see that the non-USA share is gaining the traction, but structurally these geographies are relatively lower margin. So what are the key levers which management is emphasizing or putting in to sustain the profitability? Just a qualitative aspect?
Let me just tell you with Welspun, we actually work in the mid to better to best categories. So definitely, we will maintain the margins here too. So we are not going to compromise on our margins at all. We don't work in the opening price points. So here as well, the impact is on the opening price points. So wherever that is needed, we are working on a better to best, and hence, as you go forward, our margins will be pretty okay.
Loud and clear, ma'am. That's it from my side. Thank you.
Thank you.
Thank you. Before we move to the next question, a reminder to the participants: to ask a question, you may press star and one. Next follow-up question is from the line of Soham Samanta from Motilal Oswal. Please go ahead.
Thank you, ma'am, for the opportunity, the follow-up. Just wanted to check, how do you look at the flooring business for the full year? I mean, for FY27, how do you look this business?
So the flooring business will continue to look at the focus on soft flooring, and we will continue to look at the growth here in the terms of different categories. So we have different countries here. India, again, is a very good commercial space that is growing, and there's a lot of investments that are happening in this space. So we will see India in the terms of wall-to-wall carpet tiles will grow. Globally, in the countries like, UK, now as we already spoke about UK and Europe FTA, so there's an opportunity in the terms of soft flooring there as well, also including area rugs. And there's, again, the important aspect is the geographic diversification in Australia, New Zealand, Canada, and the GCC. So there is going to be a continuous focus there. So we are working on qualitative products, and hence, our margins will not get diluted.
Okay. Just wanted to check one thing, that is there any spillover from last quarter to this quarter number in top line?
No, not at all.
Okay. And Manish sir, one CapEx point, just wanted to check what is our CapEx for this year and next year, and if you can spell out what kind of CapEx we are doing and where we are basically investing.
So as we always say that, this year we are targeting roughly around 400 to 500 crore, and that is mainly for our automation, modernization or debottlenecking. Next year, it is too early to project now because there are a lot of things going on. So maybe closer to end of this financial year, we will come back for next year's guidelines.
Got it. Thank you very much, and all the best.
Thank you.
Thank you. Next question is from the line of Aradhana Jain from 361 Capital Market. Please go ahead.
Congratulations on the good set of numbers. Couple of macro-related questions. First, we've already spoken a lot on the U.S. side, but just to understand now that India's tariff position is in U.S. has normalized, have we really seen any tangible change in the sourcing allocation in the first quarter from customers, either higher wallet share for India or consolidation towards the larger integrated vendors like you? And are we seeing any incremental order wins, or has the revenue essentially come from our existing customers in 1Q?
So let me just tell you that India definitely is in a good position. Kind of America actually needs huge capacities. And the opportunity for India stands very, very strong here, because there's nobody else in our neighbors who have that kind of a capacity. And hence focus and preferences towards India. As I earlier said, that the markets in the terms of consumption is looking better. So of course there is that incremental businesses that are coming our way, and that will continue to do so, as the demand looks very, very robust. So India is in a strong position. The demand looks robust, and so for Welspun as well, we are in a good position at the moment.
And during the last 1 year, had we lost any market share because of the tariff issues, or we didn't lose any market share of any of our customers?
So Aradhana, for us here, we have these long-term strategic partnerships with all the retailers, and these partnerships, as you know, in America, most of the businesses are replenishment businesses. And hence, we continue to work towards that. We actually worked together in the tough times in tariff as well together. We collaborated together. The demands were low. We continue to still work with them. So hence, there's nothing that has been lost at all.
Understood. Secondly, just wanted your thoughts on Rostel. Rostel is up for termination by September. So any thoughts on whether government is looking at extending it further, or how is government thinking of dealing with it? Because if Rostel gets eliminated, then for us the export incentive as a percentage of our EBITDA is quite decent. So how are we looking at it, and what are your thoughts on that?
I'll just tell you that we will wait till this happens, and we hope for the best. And I can tell you that we will. I think we will have good news only. Hopefully, that's what we pray for.
Understood. Thank you, and all the best.
Thank you. Next follow-up question is from the line of Prerna Jhunjhunwala from Elara Securities. Please go ahead.
Thank you for the opportunity. I just wanted a follow-up on the CapEx plan. With the debottlenecking, what kind of capacity increase that we can see, and when will it commission?
So here, the debottlenecking of around 120 crores that you're seeing will be in the terms of our processing, and in the terms of volume, we'll see kind of a breather of around 10 to 20 tons, per month, and that will be a big number. And because I think everywhere, as we look at it, the dyed category, or in a processing category, we tend to get sometimes choked. So that will debottleneck that.
Okay.
And Prerna, let me tell you, we already are also looking at around 400 to 500 crores in the capex. That will all be invested in all these kind of investments, which will actually help us to debottleneck and increase our numbers.
Okay. Are you also planning to expand capacity in the bath category, since you're already at 80%, and we have a large market opening up in Europe? So will we be capacity constrained in a year or two?
So Prerna, one thing is, Welspun has a global position of leadership in towels, and we will continue to maintain that. and we are not going to hesitate in investing. So when the time comes in, that kind of a opportunity also we will be taking, and the prudence will be on the ROCE that we will maintain. So yes, the investments will be happening if that opportunity is, which we'll be exploring as well. We are not going to let any opportunity pass us here.
Understood. The last question on input cost inflation. I know you've been working on cost management and stuff, but cotton price increase has been sharp in the last few months. Even the crude oil derivatives have moved up quite significantly. So, are the customers actually compensating you for increment in the cost inflation, and have you started seeing new orders at newer prices, or how are the negotiations happening? Also, U.S. tariffs, last year we bore a lot of a good part of it, of the cost there as well. So what are the thoughts of retailers on how to compensate on that front as well to the suppliers?
Prerna, this time it has been very, very clear in the terms of the costs, the raw material costs. It is going to be, passed on to the customers. It is very, very clear. This is something that we have already done, and we are in the conversation as well. And as you always know, that when the raw material cost indexes go up, and which is going up in the terms of the macros as well, so we are talking to our customers, and we are working through the prices as well. It's very clear because we'll not be able to bear those costs. When you talked about the tariff, this was done in the terms of true collaboration with our customers, where we both partnered together to face the tariff onslaught.
Okay. So we should not expect any major reversal of that cost that you have borne in future, is what I was trying to understand. So that is...
Yes. Yes, Prerna. Yes.
Okay. Understood, ma'am. Thank you.
Thank you.
Thank you. Next question is from the line of Ronak Shah from Equirus Securities. Please go ahead.
Thanks for the follow-up. So, ma'am, just on the incentive front, into our base case assumption of teens kind of the EBITDA margin, are we factoring a steady state incentive structure, or are we expecting some lapse on that? And secondly, pass through. So certain players are highlighting that for them the incentive is partly passed through, and going forward they are likely to pass on to the end consumer as well in case of any negative outcome. So how you see whole structure in this front?
This will actually be very obvious. If that's the thing, we will not be able to bear any brunt. So it is going to be the same landscape that will apply to all the retailers the way the entire position comes through. So if there's anything that happens, it's going to be borne by everybody across. So that's the way we are looking at the incentives.
Okay. And in base case assumption, we are expecting a likely continuation or a positive outcome only?
Yes, mostly. Yes.
Understood. That's it from my side. Thank you, ma'am.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you, everyone, for joining us today and for your thoughtful questions and continued engagement. As we conclude, I would leave you with one key message. Welspun Living today is a fundamentally stronger company. We have built a more resilient business with stronger customer partnerships, differentiated capabilities, a healthy balance sheet, and multiple engines of growth. As the external environment continues to evolve favorably, we are well positioned to capture the opportunities ahead and deliver sustainable, profitable growth. We are encouraged by the strong starts to FY27 and believe the quarter reinforces the direction in which the business is headed. Our commitment remains unchanged to grow responsibly, innovate continuously, and create sustainable long-term value for all our stakeholders. Thank you once again for your continued trust and confidence in Welspun Living. We look forward to speaking with you again next quarter. Should you have any future further queries, please feel free to connect with our investor relations team. Thank you.
Thank you, ma'am. On behalf of 361 Capital Markets, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.